Hey guys, Seth with GammaEdge here, coming back to you with another educational piece. Today we're going to be talking about the transition zones, which is kind of the bedrock of our trading methodology. So getting into it, feel free to read this intro if you want to. The TLDR of it is this. If you're strictly using technical analysis in today's modern markets and you're finding that that's not as effective as it once was, there's a reason for that. The reason for that is because there are new structural forces in the market that's driving price action, that being, the options market and positioning within the options market. And as we'll get to in a second, that has significantly grown since really 2019, 2020, and that is having a large influence on the day-to-day price action. And so back here, if you're still trading like it's 2015 using technical analysis, while the market has fundamentally changed, like I just said, today's markets are increasingly driven by option structure, not the support and resistance lines you learned about years ago. The gap between what moves markets and what traders are analyzing has never been wider. But here's the opportunity, and why you're watching this video, right, or reading this article. While others chase breakouts blindly, you can learn and unlock how to read structural forces that are actually driving today's price action, right? And that is done through analyzing the option structure. And one critical part of that we've implemented here at GammaEdge is identifying 3 critical transition zones that reveal exactly where to expect chop, i.e. avoid trading in these areas, acceleration, high probability entries, and reversals, which are key profit taking zones. Master these 3 zones and you will trade with structural forces instead of against them, know where breakouts have structural support, and identify traps before they happen. So by the end of this article, by the end of this video, you'll understand all 3 of these zones and unlock exactly how to identify them for tomorrow's trading session. Yes, ideally, after you read this, you will be able to implement this information into your trading over the next trading session. We're going to keep it practical. We're going to get technical where needed, but we're going to keep this information actionable for you. So let's get into why this matters real quick. And as I alluded to earlier, the numbers tell the story. Over the last decade, the U.S. options market has experienced explosive growth, with trading volumes significantly outpacing the growth seen in futures trading. Well, not only that, but just relative to stock trading on the market, the options market has exploded as well. This surge is setting new records annually, fueled by increased retail participation and the popularity of short-dated options contracts, especially zero-DTE options. And again, just hitting on the charts, just looking at the massive growth in equity options. Seeing here, SPX 0DT volume has grown 5x in the last 3 years. And then just showing, how 0DT options is now, over 50% of total SPX volume. And as you'll see, understanding the entire complex is critical to kind of our market trending framework, or our day-to-day understanding what the bigger picture is doing, but then understanding exactly what is happening in the SPX 0DT structure is critical. It drives kind of our day-to-day decision making, which we will get to as part of this lesson. And just keep in mind, it's a good thing about our framework is it's fractal, meaning what works on one time frame works on another time frame. And generally, the analysis that we perform on one instrument can be translated into other instruments. Now, there's a bit of a nuance there with one of the transition zones that we're going to discuss, but we make that known later in this article. Right, and just hitting on this a little bit further, both retail and institutional traders have contributed to the explosive growth in the options market. This collective activity is driving today's market structure and directly impacting price action in ways we've never seen before. What's most important is that due to the size of the options market today, when options volume dominates, price action increasingly follows option positioning rather than traditional technical patterns. And so, right, those clean, support resistance technical levels that used to hold, they can be rendered effectively worthless if there's large options speculation in the instrument you're looking at that is driving the price action. Now, one thing that we do want to caveat is we're not saying that options, structure, options activity is the end all be all, right? But what we are saying is that it's a critical part of today's modern markets, as we've just demonstrated through the charts. And if you're not paying attention to what the options activity in the stock or the instrument you're looking at is, then you're effectively, trading with one arm behind your back. But if you are understanding that this option structure, options positioning, this is creating a massive advantage for traders who understand it. So instead of just drawing trend lines, watching for technical breakouts, using effectively these outdated methods based off lagging indicators, you can unlock, which moves have the structural support of the options market behind it, which is ultimately fueled by the gamma and the delta. I know that's kind of a bit technical, right? Those scary Greeks, but those are effectively what are helping to drive these moves and what the options market is predicated on. And then, right, that ultimately kind of feeds its way into market makers' hedging flows as well. And just a quick plug for you, if you're not familiar with market makers, our newsletter last week was specifically on market makers and their role in the options complex. So make sure go give that a review. So, right, your edge is going to come from reading the same playbook that options positioning is writing, is creating the structure in the market. So what does that mean? That means understanding where market makers must hedge, where gamma creates acceleration of price, and where delta exposure builds pressure. And yes, if you're not new to options market, that may sound a bit technical and going over your head, but that's the exact reason why we've created these transition zones, because you don't need to understand all that stuff at a PhD level. We have created the tools and the suite of tools to make that very simple for you, so you can just understand where the zones are, and when to trade in them, when to trade outside of them, when to trade around them, right? And this isn't about predicting the future. It's about understanding the mechanical forces that are in today's modern markets that drive short-term price action, and using those mechanical forces to our advantage. And so with that, let's get into the first of the three zones. This is the DEX Transition Zone based off of gamma, and this is your acceleration detector. So you can think of the DEX Transition Zone as your early warning sign for explosive price movements. This zone shows where price will likely accelerate once it breaks free from choppy sideways action. So what the DEX Transition Zone does, essentially it's a neutral zone where options positioning minimally influences price direction. Inside this zone, neither calls nor puts have enough control to push price decisively in either direction. And there are two key levels that define it. The first, the top side of the zone, we call P-trans, or this is positive transition. This is the strike where it and all strikes above that strike are call dominated in terms of gamma. So you can think of this as your upside acceleration trigger. And then vice versa to the downside, we have in-trans or negative transition, and this is the strike where it and all strikes below it are put dominated in terms of gamma. And so this is your downside acceleration trigger. And then when price trades between these levels, you'll see choppy back and forth price action, as control shifts between calls and puts. But once price breaks outside, this is where we expect to see the acceleration happen. And the reason for this is as follows, and this is really the key unlock of this zone. So market makers face minimal directional exposure when price stays within the DEX transition zone. It is a low pressure environment for them. Right, and just backing up, market makers are not in the business of making money from directional moves. They're more in the business of making money from facilitating the trades, and so they want to have a delta neutral stance overall in their portfolio. So again, when price is in within this DEX transition zone, they are in a fairly delta neutral position, so they're really not inclined to have to implement hedging pressures into the market. But once price breaks free of P-trans as an example to the upside, market makers face rapidly growing delta exposure due to the gamma effects. The gamma effects meaning that they're rapidly increasing their delta exposure, creating directional risk, which they do not want. Again, so in this example that we're just talking about here, when we have a price breaking higher above P-trans, generally in a call-dominated speculative market, those traders, they're going to be long those calls. Market makers, therefore, are short those calls. So as price breaks through to the upside, we are getting longer as those call contracts gain value. Market makers are getting shorter. Therefore, they must be aggressively hedging, which could accelerate that move higher. And then these are the exact same mechanics in reverse below in trans, which is the bottom side of that transition zone. And again, they must be aggressively hedging as price breaks below that level. And so specifically for your trading, because that's what's most important, right? How do you use this to make money? These levels become key reference points for trading decisions. Once price moves through P-trans or N-trans, we expect acceleration in that direction. And this is where the odds stack in your favor. And right, conversely, if price fails to hold these breakout levels, breakout zones, and moves back into the transition zone, and this is a clear signal of choppy conditions and quickly invalidates your directional thesis. Right, and the key point of this is that P trans and N trans are not traditional support and resistance levels. Should not think about them that way. We expect price to accelerate through them, not bounce off of them. And so, right, like if you're into technical analysis, something we've seen is right. These levels we're talking about the transition zones. These are market generated levels, right? So we often see good confluence with your traditional technical indicators as well. So looking for that confluence can be very beneficial in your trading. And so just going through a real example of you below here, this is our web app dashboard. This is a visualization of the option structure. Specifically here, we're looking at SPY. We have all expirations in focus of the analysis. Just looking at the DEX transition zone, which we draw automatically for you. That's between 517, which is N trans, and 520, which is P trans. Keep in mind, this is from May of 2024. So this is not a current example. This is just an example for the sake of the newsletter. Right, and so when we're in the middle of this transition zone, like it's very clear looking at just we call them the gamma bars, which are this right here. We can just see they're very indecisive back and forth, relatively small compared to what the gamma bars, the gamma profile looks like once we shoot out of that transition zone. Something that we do want to note though is, looking at this specific example, just because we would break below N trans, that doesn't mean that we're blindly shorting the stock. Reason being is that this is a call dominated environment. Looking at the delta, which is, representative of the positioning of the speculators in the complex, we can see green above and below spot price, which is a call dominated environment. This is kind of a fundamental backdrop of what a bullish market environment looks like. Right, and so if we were to lose N trans, there would need to be multiple factors that we would want to see before we would consider shorting. Right, so that would be, a deterioration in our market trend model, deterioration in intraday volume analysis. We would need to see, puts starting to show up below spot price. And again, just going to our blog real fast, this article called Spotting Bearish to Bullish Market Shifts. This is our full kind of soup to nuts methodology that we outline in this article. So if you're not familiar with what we just talked about, we really do a good job of showing examples in this article. And then, the intraday volume analysis we cover in this article, market trend model we cover in this article. So the point being, if you're not familiar with one of the tools that we are discussing in the article, we should be linking to it, and we're linking to one of these blog articles. So going back to this specific example, in this call dominated environment, if we do drop below N trans, this should be the first signal that we should be thinking to ourselves, hey, bulls may not be as strong here as we thought. And from this point forward, we would want to see, one, if bulls can quickly reclaim P trans, or two, the structure starts to deteriorate, meaning that call speculators are removed from the complex and put speculators step in. And the way that you would see this in this visualization is, all this green shifts to red. And so now that you understand how gamma drives acceleration, let's look at the second zone, which reveals something even more fundamental: who's actually in control of the market. And so next we're moving to zone 2, which is the DEX transition zone, which is based off of delta. And so just starting out here, if DEX shows you the strike where prices are likely to accelerate, DEX or delta shows you which direction the market wants to go. This is your sentiment compass, the zone that reveals who's in control based off of actual positioning, not just short-term speculation. So the DEX transition zone cuts through market noise to show actual market direction. Unlike GEX, which can shift dramatically as price moves, because gamma is most sensitive to near the money, at the money, DEX provides a stable view of market structure. And so the DEX transition zone has boundaries, P trans and N trans, just like the DEX transition zone that we just talked about. However, this zone is based off of the net OI column in our web app dashboard, which you can think of effectively as the distribution of speculation in the market. So think of this as like the total size of speculation occurring at a specific strike and then up and down the entire complex. So getting into specifically how it works, DEX focuses on the moneyness of options, essentially asking, are there more calls or more puts at each strike? This effectively tells you what market participants expect to happen, not just where they're speculating for quick moves. Just quickly looking at the net OI column, green strike means that calls are dominant at that strike, and red means that puts are dominant at that strike. And so just to reiterate, a break above DEX P trans, that means that all strikes above are called dominated. Break below DEX in trans, and those are all strikes below are put dominated. So specific to your trading, again, always bringing this back to your trading and how you can use this tomorrow in your trading. DEX is less sensitive to current price movement than GEX. So delta less sensitive than gamma, making it your primary decision maker for trading direction and risk management. It shows you the underlying structural bias that persists despite short-term fluctuations. Like the GEX transition, the area between the DEX transition often exhibits choppy price action due to the back and forth between call and put speculation. Right, and again, like we talked about with the GEX transition zone, market maker exposure shifts within a tight range, creating the sideways grind that often frustrates trend following strategies. So again, if you're a swing trader, be very beneficial for your strategy to understand where that transition zone is and where we could be experiencing that choppy price action. Right, and the beauty of looking at the web app is we can quickly see, scanning the net OI column, where we can see that structure really change, or where that shift from green to red happens, or red to green. And by viewing the structure through the lens of DEX, we can identify those areas of change in the structure. And so, for example, when we cross the top of the DEX transition zone, we know there's an imbalance where calls dominate for that strike and all strikes higher, and then vice versa to the downside. And the key insight is this: when GEX and DEX zones align tightly, you'll have a high confidence structure. When they're far apart, expect uncertainty in wider ranges. And so if you're watching this video, know that in the article itself, there is going to be another YouTube video embedded, which is more of a deeper dive into the DEX transition zone. Right, and those key takeaways from the video are this: the DEX transition zone is a bit more stable view than GEX, as it's determined by the market speculation, the distribution of speculation, and not necessarily spot price movement. The net OI column within the dashboard itself is the critical way that we understand where this transition zone is. The area in between the top and the bottom of the DEX transition zone is often exhibits choppy price action. Confluence between the two zones is a signal of well-defined market structure, which reduces the nature the nature of choppy price action and gives clearer market behavior. And then wider zones themselves and greater distances between the GEX and DEX transition zones are more signaling market uncertainty. So lastly, while GEX tells you where to expect acceleration, DEX tells you the directional bias. What happens when you break out of these zones? That's where our third zone comes in, which is significantly designed for the unique challenges of trading 0 DTE. And that third zone is called the Drunken Sailor Zone. And so why that name? Like a drunken sailor wandering unpredictably down a dock, price can stagger back and forth within certain boundaries after breaking out of the GEX and the DEX zones. This erratic movement frustrates traders who expect clean directional moves, but it's not random. And this is exactly what this transition zone outlines. Keep in mind that this zone is specific and unique to SPX 0 DT trading and focuses on where price tends to meander. While GEX and DEX may show you initial breakout zones, the Drunken Sailor range reveals where that breakout may lose steam or find renewed energy. So what makes this zone different from the GEX and the DEX transition is those latter two zones focus on the dominance or calls and puts within the structure. However, the Drunken Sailor range analyzes the net open interest distribution or the gradient or lack thereof throughout the 0 DT structure. And by gradient, what we mean is we're looking at the increasing and decreasing size of speculative positioning based on how calls and puts are distributed across strikes. This deeper analysis helps identify where price may encounter resistance or support with greater precision than simply knowing calls are in control here. Here, just looking at an example real quick. I know it may be kind of hard to see, but you can look at the newsletter. DEX transition zones, very tight confluence, 60-40, 60-45. And then this gold box is where the drunken sailor zone is. And we can see that it extends all the way up to 60-60 in this example. Reason being is, you can clearly see how the net open interest, again, the distribution of speculation, goes from 500, 800, 900, 1700. So that's where that gradient comes into play, to where, that distribution of call speculation may be kind of small initially within the DEX transition zone, but then over time it kind of grows until we kind of find where, like, there's a massive level where a ton of speculation is. And that is kind of the key make or break level in the SPX 0DT complex, which the Drunken Sailor Zone highlights, which, as we said earlier, is where we could run out of steam. But also, if we're able to overtake that level, that is where we kind of get our second wind. And so the three key factors for this zone is net OI distribution, i.e. how call and put speculation is distributed across different strikes. Charm decay, which is time decay's accelerating impact as we approach expiration. Again, this is very critical when trading SPX 0DTE. And then volume requirements, how much trading activity is needed to push through each level. And mainly, how much is needed to push through those top and bottom goalposts that the Drunken Sailor range identifies for us. And so when to use the Drunken Sailor zone? Well, we rely on this is most valuable after price is broken through the DEX and the DEX zone, as it helps you identify likely areas where breakouts may stall, set more precise profit target levels. Both of those are able to help you right with your risk management and position sizing, and then understanding kind of when to avoid trading altogether. If we have massive transition zones, as an example, could be wide undefined ranges, or maybe that is an environment where you thrive on. Now, specific to your 0DT edge, in a compressed time frame that is 0DT, understanding where price might meander can be the difference between holding winners and watching profits evaporate. The Drunken Sailor range sets realistic expectations of how far moves might extend and where they're likely to encounter obstacles. And then again, just putting it another way, the GEX and the DEX transition zones show those sharp changes in transition in the structure, right? But the Drunken Sailor range is where we focus on the gradients, which are the gradual shifts. And these gradual shifts are kind of what create that wandering price action. So again, if you're watching this video in the newsletter, there's going to be 2 additional key videos, kind of deep dive videos into how we actually use this in real examples. So I would make sure that you go and you watch those videos. And again, the video is going to cover how the Drunken Sailor range works, how to identify it, most importantly, how to incorporate it in your existing trading strategy. So lastly, understanding each zone individually is valuable, but the real edge comes from reading them together. When you learn to unlock how to combine all 3 zones, you can distinguish between high confidence setups and potential traps. So those high confidence setups is mainly going to happen when you have tight alignment between the GEX and the DEX transition zone. This shows you that short-term speculation and underlying sentiment via, the former by GEX, latter by DEX point to the same direction. This tight alignment means that market makers have clear, defined risk parameters. Breakouts are more likely to follow through. Price movements tend to be cleaner and more directional, and your risk-reward ratio improves significantly. Warning signs, as we talked about earlier, is the wide divergence and really just the overall large transition zones. And again, when these are far apart, you're looking at conflicting forces in the market. GEX might show tight acceleration, but DEX reveals mixed sentiment or vice versa. And specifically, these wide divergences, wide transition zones means that there is market uncertainty, or the market could be undergoing some kind of transition, higher likelihood of false breakouts, choppier price actions even after the breakout zone. And this is your time to reduce position sizing or just sidestepping the market altogether and wait for better conditions. And then integrating the Drunken Sailor zone on a 0DT basis. Once you've identified GEX and DEX alignment or lack thereof, the Drunken Sailor becomes your precision tool for 0DT execution. After a clean breakout of the former zones, use Drunken Sailor levels for profit-taking decisions. or parts in the structure where we may see the next leg higher. Yes, I understand that statement is not black and white like we want it to be. That is gray, but that is trading. Trading is trading the gray and doing it successfully, right? In choppy positions, the drunken tether range helps us avoid the worst of the meandering action. And then position sizing, wider drunken tether suggests smaller position sizing due to the increased uncertainty. And so just as a quick framework for you before entering a 0DT trade, run this simple check. Are the GEX and DEX transition zone aligned? Which, i.e. high confidence or more of a wait and see mode. How tight are those zones? Explosive potential per grinding action. And where does the drunken sailor range suggest? What does it suggest? Sorry. Realistic profit targets or exit planning. This zone framework helps you focus on structural forces while filtering out the noise that derails most 0DT traders. So now getting into some common FAQs that we get. Which zone should you prioritize when they conflict? So the DEX needs to be prioritized for directional bias and the GEX needs to be prioritized for timing. When these zones are widely divergent, consider reducing your position sizing or waiting for when they do become better aligned. Conflicting zones often lead to choppy price action, choppy, unpredictable price action that, is difficult at the end of the day to trade profitably. Do these zones work for swing trading in other time frames too, as opposed to specifically SPX 0DT? And the answer is yes, absolutely. As I said before, the DEX and the GEX methodology is fractal, meaning it works across all time frames, all underlines that have a liquid, robust options market. Like if you're looking to apply this to some meme stock, that is not appropriate because options market are not influential in driving that stock price. And one thing to clarify is the drunken sailor range is specific to SPX 0DT due to the unique time decay characteristics and volume patterns of same day of the 0DT options. And then for longer term time frames, focus on the GEX and DEX combination. And just one point to call out, our successful P-Transit plus GEX, which we had a newsletter about that a couple weeks ago. We have a video on that in our curated playlist in the description here, which has significantly outperformed the SPX buy and hold on really any time frame that you look at. 100% mechanical, and that relies exclusively on the GEX P-Trans level. Third question, how do I find the transition zone in the platform? So as we said earlier, the GEX transition zone is automatically plotted for you in the web app dashboard. In terms of the DEX transition zone in the web app, in the drunken sailor ranges, we manually draw these for you each day as part of our pre-market routine that we post every day in the Discord. We are working to get these automated into the web app dashboard, but for now they are automated, they are manually drawn by us. Fourth question, what happens when price gets significantly extended from these transition zones? So think of this like a stretched rubber band. The further price moves from the transition zones, the higher the probability of reflexive move back towards the middle. This is especially true in 0DT where time decay accelerates these mean reverting tendencies. When you see price significantly extended from all three zones, consider taking profits on directional trades and looking for counter trend opportunities back towards the center of the zones. The market tends to snap back when structural force is too far from these structural anchors. Last question, how do these zones work with other GammaEdge tools? So these zones are most powerful when combined with the market trend model and our intraday volume analysis. And, especially intraday volume analysis is really most specific to SPX 0DT trading. Market trend model, cumulative tick, filtered tick, very important for intraday trading to get confluence with our intraday volume analysis as well. But then on a longer term time frame, understanding the RoboTrax longer term moving average ribbon over market trend model is important with where price is trading relative to the DEX and the GEX transition zones. So for upside breakouts for upside breakouts above P-Trans, we also want to see positive momentum in the market trend model and constructive intraday volume patterns. Without this confluence of momentum, even clean zone breakouts can fail. And then it's the vice versa thinking to the downside. We want to see those negative trend signals and distribution style volume patterns to confirm the move has structural support. And that is really a breakdown of the structure and selling coming into the market. And then during choppy sideways actions, market trend models moving sideways, we have mixed intraday volume signals, which is confirming this range bound environment. And this is the perfect time then to step aside, trading smaller, or if you spend any amount of time within the community, you know that we have a lot of folks that like to sell premium on both sides of the market. The transition zones, intraday volume analysis, they're all very critical in understanding where those upper and lower goalposts are. So, yes, this is great in helping to identify those trendy moves, but this is even better potentially for understanding where the market is likely not to go. And a lot of money can be made if you do understand that. And just to kind of round out these tools, these zones we've discussed today show where things might happen, but the market trend model and the volume analysis confirm when and how they are likely to unfold. And so a pro tip, this is especially critical when trading the Drunken Tether range. Remember, these zones represent significant speculative buildup in the structure. You need to see substantial, intraday volume accelerating through the Drunken Tether zone level to expect continued momentum higher or lower. Without this volume confirmation, price often stalls or reverses at these levels. Exactly the wandering behavior the zone is designed to identify. So, right, that is what we mean when we talk about the Drunken Tether zone, the top and the bottom, those two key goalposts or spots where we could see a likely fizzle out of the move, or if we see the next kind of second wind higher. It's really all predicated on the intraday volume that we are seeing transact in the market. And again, as we are walking up that gradient or down the gradient, if we're going to the downside, that's exactly what we mean. As we get towards those dominant strikes in the gradient where there's a ton of speculation sitting there, due to those charm impacts that we've discussed a little bit, or at least hit on in this article, you need to see a lot of volume come into the market, flood into the market to then overwhelm those kind of offsetting charm impacts. So we can flip that and we can progress higher. And with that, you now know all three of our transition zones, and hopefully, ideally, you can kind of implement this into your trading starting tomorrow, or at least anything. Plot these zones on your chart and just understand how price is interacting with them on a daily basis, because they are. And really, this is our key framework that we go through every day, both for setting our SPX 0DT time frame, but then broadly understanding more of how the market is positioned on a multi to multi-week, what we've referred to as a swing trading time frame. And so lastly, here is a simple truth. Each morning we use exactly this process to break down the 0DT structure. You've probably seen our YouTube videos we do in the morning and our nightly recaps where we dissect the zones in the pre-market and review how they played out post-market. Exactly what I said, repeated myself. Now you understand what we're looking at and why these levels matter so much to our trading decisions. The beauty of this approach is its simplicity. While other traders are drowning in dozens of indicators, you're focused on structural forces that actually move the market. You're reading the playbook that options market speculators are writing. And again, this isn't about predicting the future. It's about understanding the mechanical forces that drive short-term price action in the options-dominated market. Knowing where the prominent positioning sits and how market makers must respond, you can position yourself with the flow instead of fighting against it. The framework is complete. The levels will be marked for you each morning. All that's left is putting it into practice. So with that, appreciate your time. Hopefully this is clear. If it's not, email us, give us a comment in the description of this video, do it in Discord. You know how to reach us, and we will do our best to further explain this to you as needed until it sinks in and you get it. So with that, I appreciate your time. Until next time, talk to you later.